Now on BBC Two, time for tonight's Newsnight with Emily Maitlis.
Tonight, Mark Carney pulls the plug on a scheme to help home buyers. Does this betray his fear of a housing bubble to come?
It would no longer be appropriate or necessary to have our foot on the accelerator. It's better to shift into neutral, and that's why these changes for the FLS have been made.
This man once said he wanted to be king of the world. Tonight, Boris Johnson's accused of unpleasant elitism. The policy that caused violent protests on the streets and prompted this.
I'm sorry, I'm so sorry. There's no easy way to say I'm sorry, I'm sorry.
But how's the row over tuition fees all been for nothing? We explore the £5 billion black hole. And what happens when you turn your back on your parents' religion and have to tell them?
She began to cry. She said to me, Amal, if it's between you and Allah, I choose Allah.
Hello, good evening. Is Mark Carney getting cold feet about the UK housing market? Today, starkly, one of his mortgage lending schemes was shut down. The Funding for Lending programme, which allows people to borrow at low rates, will no longer be available for home buying after the end of January. The Bank of England's concern, he made clear, was the unexpected speed at which house prices were rising in many parts of Britain. Time, he suggested, to take his foot off the gas before the interest rates underpinning this fragile economy would have to go up. Of course, there are other ways of borrowing cheap money to buy a home. The government flagship scheme, Help to Buy, remains untouched. But sceptics may wonder for just how long. Here's Andy Verity.
Who's setting the course for the housing market? As evidence mounts of house prices getting even less affordable, the Treasury's answer has been to use government money to help buyers pay those prices, loosening lending. But today, the Bank of England fired a shot across the Treasury's bows.
But risks to financial stability may grow if there are further substantial and rapid increases in house prices and further buildup of household indebtedness. These risks would be amplified if underwriting standards on mortgage lending were to weaken, as has been the case in previous house price cycles.
Until today, the governor had been content to go along with the Treasury line that the risks of a bubble were remote. But today he presented mounting evidence that there were significant risks in the housing market. On this chart, the two bars on the right represent those whose mortgages are more than 4 times their income. They hold nearly a third of the country's mortgage debt. On its own, the bar on the right shows those borrowing more than 5 times their income. They hold nearly a fifth of mortgage debt. The Bank of England's Funding for Lending scheme is one reason we've got some of the cheapest mortgages ever offered. You can borrow £500,000 and pay just £621 a month. No wonder some people, now including the Bank of England, are worried about house prices taking off.
40% of outstanding mortgage debt is held by people who have a debt equal to or greater than 4 times their income. Clearly this is quite a high number and could cause concern under higher interest rates.
Funding for Lending makes cheap funds available to banks with interest rates at 0.25%, a measure introduced last year when the Eurozone crisis threatened to derail the recovery. But shares in construction companies plunged today when the Bank of England made it clear it was withdrawing that for household lending. In its financial stability report published today, the big fear is less double dip, more double bubble.
It might be an increasing shift, really, in the Bank of England's thinking about what's more worth worrying about, maybe, which is that the problems with affordability, the structure of the house, the housing market, the prices one has to pay in central London, etc. Actually have an impact on financial stability. And what they seem to be saying in the financial stability report is that they have the policy tools to be able to address that.
Mark Carney's got reason not to want his tenure at the bank to be marked by a housing bubble. While governor of the Bank of Canada, he was accused of presiding over exactly that. with buyers stretching to mortgages more than 4 times their income. Now he's warned that he may act to make mortgages cost banks more to lend than other loans. When a bank lends you the money for a mortgage, its biggest cost isn't so much the interest it's going to have to pay to get hold of the funds, it's the capital it has to set aside. Now, the rules on that are set by the people in here, the Bank of England. And what they've been saying today is if they see the housing market taking off, they could tighten those rules. Right now, for every £100 of money they lend, they have to set aside £1. If the Bank of England raised that to, say, £2, it would double their costs and mortgages would become more expensive.
What the Bank of England could do is raise capital requirements on areas in the bank's balance sheet where risks were beginning to rise. And what that could mean, in our view, is that, for example, higher loan-to-value mortgages, mortgages with higher price-to-income ratios, could attract higher capital requirements from the Bank of England.
And therefore higher costs?
Yes.
The Treasury had one answer to rising house prices, loosening lending to the most stretched with the help of taxpayers' money. The bank hasn't stopped that, but its warning shots can't be ignored. Don't expect mortgages to stay quite so cheap.
That was Andy Verity, and joining me now, the economist and Reuters columnist Anatol Kaletsky and Professor Mariana Mazzucato from Sussex University. Welcome to you both. Was this the right move, Anatol?
No, I think actually it was the wrong move. Most economists believe that the Chancellor was making a big mistake 6 months ago when he created the Help to Buy scheme. I was one of the few who said at the time, this is the one thing that the government has done that could actually turn the economy around. And it did turn the economy around. I think the reason why the UK economy has been surprising most experts on the upside, has been doing better than any other European economy now for the first time in 5 years, is the revival of the housing market.
So he should have just let this one run?
No, I think this is the kind of action the Bank of England will probably have to take and should take 2 or 3 years from now, once the economy is recovered and once we are back to a normal economic situation with unemployment back to 6% and so on. But I think it's too early to do it, and it does endanger the recovery.
So he shot his goose a bit too soon.
Well, I think that he's right for 2 reasons and he's wrong for 2 reasons. I think he's right because what he's basically saying is that we don't want to fiddle with the economy through the interest rate by increasing it in terms of, stopping this overheating, because actually we still have very low private business investment. So he, reintroduces this concept of regulation. So he wants to increase leverage ratios and he wants to change the type of lending. We don't want to lend to the speculative economy, so to give mortgages out to consumers who actually probably won't be able to pay back those mortgages, especially once interest rates do start changing. But I think he's wrong in the sense that basically what we're trying to do, and I think anyone who's thinking about growth, is how to rebalance the economy away from a speculative finance, if you want, towards productive finance. And I think this emphasis that somehow it's going to happen by lending to SMEs, where, if you look around the world and including the UK, SMEs actually don't produce that much sort of net job creation, innovation,
so there is a chance that the growth from a housing bubble will be better than what comes next, which could be no growth.
No,
from
but
a housing
the
bubble.
main point, though, is that the problem right now in the world, but definitely in the UK, is not the quantity of finance. There's plenty of finance out there. There's not the right quality. What we need is long-term, patient, committed finance that actually helps the types of companies that do want to invest in these long-run growth areas to actually be able to do that. And it's independent of size. There's small, there's medium and large companies that need that. But none of these reforms are actually increasing this long-term, committed, patient finance. He's still trying to go through the banks, just like Vince Cable with his business bank was still going to go through the private banks, whereas in places like Germany, but even in the US, where they have huge public funding agencies, there's direct lending to companies.
I mean, Anatol, you said you were directly at odds with a lot of economists. Essentially, all these homeowner lending schemes have been politically popular, but economically slightly crazy, haven't they?
Well, I don't think it has been crazy. I think this is a case of a measure which I think was initiated for political and, if you like, quite cynical and manipulative reasons. It was all about winning the next election, but it happened to be the right thing to do for the economy at the time, because you know, at the beginning of this year, the economy was in its deepest and longest slump in history, and there was no prospect of turning that round.
But just
and this actually
explain to
began
us,
to turn things round.
But where does the dynamic sit now between the Bank of England and the Treasury? Because who clamped down on this exactly?
I think that's a great question, because my assumption now, of course, as an outsider, was that when George Osborne introduced the Help to Buy program, it was more or less the same time that he announced Mark Carney as the next governor of the Bank of England. So my assumption, I think most people's, was that he must have consulted the new governor to ensure that he would be supportive of this program. And that's exactly how things seemed for the for the first 3 or 4 months with Mark Carney at the Bank of England. But he suddenly and quite inexplicably seems to have changed his position. And to me, I was thinking about this. This is a bit like Thomas à Becket and Henry II. You know, if Mervyn King had still been in charge, it would have been very hard to introduce the Help to Buy program.
And do you think Help to Buy is now similarly under the microscope?
I just don't think that that's where the problem is. And I mean, I think, sorry, just going back to your previous question, I mean, the real schizophrenia is in the Treasury. And I do actually have quite a bit of faith in Carney. I think he has read Keynes, you know, and Keynes' main point is that what drives private business investment are these animal spirits, right? Your gut instincts about where the future technological and market opportunities are. And little fiddling with the interest rate actually doesn't really change that. So he's trying to think, how can we, again, rebalance away from speculative finance towards productive finance to actually eventually increase that private business investment. And I think the problem in the Treasury is there's no proper theory of economic growth. This is why, by the way, even the industrial policy and the innovation policy, which is finally back that BIS, the Business Innovation and Skills Department, is trying to do, is actually having very little effect because it's not embedded and coherent with what the Treasury is saying. And I don't really actually think the Treasury has a theory of economic growth.
But I think what you're missing, Mariana, is that businesses are not going to invest unless they see consumer demand. What generates animal spirits is the knowledge that people out there are going to buy your products and services. And that is how a housing recovery was beginning and is beginning to feed into the broader growth of the economy.
I think housing recovery is like, you know, again, one thing that Keynes didn't get right was, you know, he said that, you know, digging ditches and filling them up again is somehow going to cause economic recovery. That's kind of like this housing point, just build a bunch of houses.
Presumably,
That's not
when you take away the ability for all those people to be able to get a mortgage from lending, and you've got all this QE floating in at the other end, the gap between those at the top and those who are not able is even bigger. That's what this is doing, isn't it?
Well, yes. I mean, inequality was both a cause and an effect of the financial crisis. There was too many people taking out these, not only bad loans, even good loans in the U.S. that just didn't have the income. I mean, real incomes have been stagnant for 30 years.
But again, the Help to Buy was beginning to redress that, and we're just getting to the point where it's beginning to move out from London to the other parts of the country where actually houses are not expensive. The average house price in this country is £170,000.
We've got to leave it there, but thank you both very much indeed.